Hello and welcome to the Tuesday, February 4th, 2020 edition of Tesla Daily, unofficial Tesla podcast. My name is Rob Maurer. We have a few things to go through today, but first we'll start with the stock, of course, which had another crazy day on the day today, beginning in pre-market, where Tesla just completely blew through the $800 price band to top $900 before trading even opened for the regular session today. This gives us an interesting update to the price band timeframes that we talked about yesterday. In terms of Tesla going from 300 to 400, remember that took 976 days. 400 to 525 days, 500 to 618 days. We saw 600 to 700 in 4 days. That happened yesterday. And then, of course, one more day to 800. And then 4 hours in pre-market this morning to go from 800 to 900. Just pretty crazy to see all of those lined up like that. In terms of the stock price movement today, as I said yesterday, that had felt like the quote-unquote squeeziest day to me so far. And then, of course, February 4th came along and it felt even squeezier. So I did have to question myself a little bit today on if we're converting more from a short covering rally and a fundamental repricing to more of a short squeeze type of situation today. I'm still not fully on board with that thesis, but I am more willing now to at least entertain that idea. In terms of the rest of the trading today, there was a strange decline at about 12 minutes to go before trading closed today, where Tesla fell by about $80 per share over the course of 6 minutes. So if you are watching this on the YouTube version, I've put the timestamps here. You can see that Tesla was actually rising into close to hit the all-time high and the high of the day at $968.99 with about 12 minutes to go in trading. And then over the following 6 minutes fell by $80 to $889.13. So that's pretty close to where Tesla ended up the day at $887.06, up 13.7%, which is a $107 increase. A little bit shy of yesterday's $129 increase, but over the course of the day today, Tesla at one point was up more than the total share price value was back in June, more than the $177 share price back then. That was pretty close to where Tesla ended the day, around $887, and at least as I'm recording this, it has recovered a bit in after hours to $904. It's anybody's best guess as to what drove that sell-off. It didn't seem to be anything related to any sort of specific news. So I have a couple of theories here, but I think all of them include stop loss orders. A stop loss order is just a limit order that someone would place to try to limit their downside, where if the stock falls to that price, that will initiate a sell order for whatever their position is. If enough people have that, that can lead to some pretty rapid declines as people sort of rush towards the exit, and those stop loss orders keep getting hit, driving the stock price even lower, hitting more stop losses, etc. So I think that's probably a situation that was at play. As to what caused that, that's anybody's best guess, as I said. A couple of theories here. One would be day traders, potentially looking to close out their position before the end of the day, that causing some pressure leading to further pressure. A second could be a short seller or group of short sellers looking to cap off the momentum that Tesla was experiencing. As I said, it was rising into the end of the day. That can be a scary proposition heading into the next day. So placing some sell orders there and putting some pressure on and hitting some of those stop losses could be a good strategy if you are short. And a third option could be a long selling for a similar reason to try to put some pressure on and then maybe accumulate those shares again at a lower price. I think that's probably the least likely of the three. What I think is less likely than any of those is just a long exiting their position. Generally, if you're exiting a position, you're going to try to get the best price on all those shares, especially if it's a high volume position like it would have needed to be in this scenario. So in a situation like that, you tend to unwind that position slowly so that you're not putting all of this pressure into the market at once, causing a significant price decline, which then gets you less money for your shares than simply unwinding it slowly throughout the course of the day or a couple days, for example. So what I don't think was happening at the end of the day was just a long being like, all right, I'm taking my gains and I'm getting out. It's possible, but it seems unlikely versus some of these other scenarios. Again, that is all speculation. That's all anybody can do on this, and I'm sure other people will have different thoughts in the comments below. Staying with the stock, but moving a little bit into the news, Barron, who has obviously been invested in Tesla for a long time, I think since 2014, was on CNBC today discussing Tesla and the rise that we have seen. Barron emphasized that he is still very bullish on the company, looking at the long-term future outlook, emphasized that they have not sold a single share and don't plan to, and that if it were up to Barron, he would continue to buy more if possible. And most of the rest of the conversation was focused on contextualizing the current price for Tesla, and I thought he did a really good job of that. That's kind of what I was trying to do yesterday in terms of how flat the stock has traded for a long time and we're just playing catch up now. So Barron explained it by looking at revenues from 2014 compared to the stock price. So annual revenue back in 2014 for Tesla was $3.2 billion. Tesla stock at that point in time traded as high as $280 per share. So in 2020, Tesla revenues should be at least in the ballpark of $32 billion. I expect higher. So they've 10x'd revenue since 2014. And here we sit with a share price around 900. That is barely 3 times more than the share price in 2014. And of course, there's been dilution, so the market cap is more than 3 times higher. But I thought that was a really helpful perspective to share as a counter-argument to people that would call this a bubble or simply the result of a short squeeze, stuff like that. Because Tesla has been more aggressively valued with less tangible fundamental results in the past. And yeah, you could argue that maybe Tesla was overvalued back then, but if you look at the stock price today and you use that as a gauge for value back then, well, it turns out it wasn't actually overvalued. And I expect we'll be back in the exact same situation 5 years from now when Tesla's at X $1,000 per share. So I thought Barron did a nice job in that conversation, very long-term focused as he tends to be, which is nice to see for a change, especially coming from CNBC. He again emphasized his belief that Tesla can be a $1 trillion revenue company in 2030. And he said that's without the battery business, so you can see why he wants to buy more shares of Tesla. He also got asked a ridiculous question in this interview by Andrew Ross Sorkin, one of the hosts of CNBC, who was talking about the 420 saga with Elon trying to take Tesla private. And about that, he said, quote, "Do you think that he was trying to rob the shareholders?" End quote. In terms of Elon trying to buy out the company private at 420. That is such a ridiculous question given the context at that point in time. People were saying that Elon made that price up and that there would be no funding. That's why the funding secured thing was such a funny joke to everybody. And now we have to sit here and have someone legitimately ask the question of if Elon was trying to rob the shareholders. It's infuriating. The entire reason Elon didn't take Tesla private was to protect the shareholders because he realized that he wouldn't be able to bring the current shareholders along in that take private deal. Now, you can choose not to believe that if you want to, but that's what Elon said. And regardless of any of that, this is still such a ridiculous question. Anyway, Ron Barron did a great job in that interview. They actually gave him some time to discuss his thoughts, which was nice. So I'll put a link to that in the show notes. Definitely worth a watch. Next, we'll move on to Baillie Gifford. They have disclosed in their end-of-year filing that they increased their position in Tesla throughout the year from 13.2 million shares to 13.8 million shares, so added about 600,000 throughout the year this year, or last year rather. And speaking of the funding secured saga, which sort of kicked off with news that the Saudi Arabia Public Investment Fund was acquiring Tesla shares, they have filed in their end-of-year filing that they sold 8.2 million shares, which was 95% of their stake or so, in Tesla in the fourth quarter. So they're pretty much all out, at least they were at the end of the year, only having about 40,000 shares left. Does add some intrigue to the possibility that maybe they were starting to at least attempt some sort of a hostile takeover of Tesla back when that saga unfolded, and maybe Elon did tweet that somewhat defensively to keep that from happening. It seems a little bit weird that they would just decide to sell off all of their position this quickly, and that they couldn't have really picked a worse time to do it, although I guess June would have been a little bit worse. Next on the list is New Street Research. So Pierre Ferragu has downgraded his rating on Tesla stock. Remember, he was one of the street high price targets with an $800 per share price target. He's moved his rating down from buy to neutral, saying, quote, "Not a change in our views on the company, just recognizing that the stock more than quadrupled from last year's lows," end quote. Also adding that Tesla has a, quote, "unattractive risk profile for the rest of the year," end quote. We also heard from Citron Research on Tesla, which we haven't heard from for a while. That's Andrew Leff's fund, which started off short Tesla and went long Tesla, then went neutral Tesla, and now is back to short Tesla, saying, quote, "We love Tesla and promised never to be short again, but when the computers start driving the market, we believe even Elon would short the stock here if he was a fund manager. This is no longer about the technology. It has become the new Wall Street casino," end quote. Well, I guess it's hard to completely tear away from your short roots, but as we've talked about both today extensively and yesterday, there are plenty of reasons that are not algorithmic for Tesla to be valued where it's at today. So I would disagree with his assessment here. Next piece of news is on Ford. They reported their fourth quarter earnings today, and the stock after hours was down 10% on the news. They gave lower guidance for earnings for 2020, saying that earnings before interest and tax would come in between $5.6 billion and $6.6 billion. compared to adjusted earnings this year of $6.4 billion, so a guided range of down 12.5% to up 3% for earnings for 2020. Ford also posted a $1.7 billion net loss in the fourth quarter, driven by $2.2 billion in charges for pension and retirement funds, which are viewed as non-recurring, but it's not the last payment like that Ford is going to have to make. The last quick thing for today is an update on safety for Tesla for 2019 that they posted in a blog post today, saying, quote, "As we produced significantly more vehicles, our injury rates went down. Compared to 2018, our rate of injury per vehicle produced was reduced by more than 50% from last year," end quote. Because they didn't give us the actual number of injuries, I was a bit curious to see if that actually increased or decreased year over year because production increased by 43%. So the math actually works out that injuries, regardless of the production rate and the number of injuries per vehicle, actually went down from 2018 to 2019, despite more vehicles being produced. So on the YouTube version here, you can see just some hypothetical numbers to work through the math. And to get the injury rate to have fallen by 51% per vehicle on that 43% production increase, the actual raw amount of injuries would have had to have been down by at least 30% from 2018. A lot of numbers there, so I'll say that again. Despite increasing production by 43%, to get the stat that Tesla is talking about in the safety update, injuries would have had to have been down 30% from 2018. So really good progress. Tesla also shared that, quote, "Our injury rate continues to be below the industry average," end quote. So a nice little update there from Tesla that was mostly shrouded by the stock price drama today, which I'm sure will be back tomorrow. But that'll do it for today. As always, thank you for listening. Don't forget to follow me on Twitter at Tesla Podcast, and I'll see you tomorrow for the Wednesday, February 5th episode of Tesla Daily. Thank you.